5 proven methods for selling stocks.
On the flip side, if the stock price fell by 10% to 20%, a good majority of investors still won't sell because of their reluctance to realize a loss in the event that the stock rebounds significantly. These methods are the valuation level sell, the opportunity cost sell, the deteriorating fundamentals sell, the down from cost and up from cost sell, and the target price sell. Investors should be as methodical as possible, removing any emotion from their decisions. The first selling category is called the valuation level sell method. In the valuation level sell strategy, the investor will sell a stock once it hits a certain valuation target or range. Numerous valuation metrics can be used as the basis, but some common ones are the price to earnings (PE) ratio, price to book (PB), and price to sales (PS). As an illustration of this method, suppose an investor holds stock in Walmart (WMT) that they bought when the PE ratio was around 13 times the earnings. An additional strategy is called the opportunity cost sell method. In this method, the investor owns a portfolio of stocks and sells a stock when a better opportunity presents itself. Once a better potential investment has been identified, the investor then reduces or eliminates a position in a current holding that isn't expected to do as well as the new stock on a risk-adjusted return basis. The deteriorating fundamental sell method will trigger a stock sale if certain fundamentals in the company's financial statements fall below a certain level. This selling strategy is similar to the opportunity cost sell in the sense that a stock sold using the previous strategy has likely deteriorated in some way. When basing a sell decision on deteriorating fundamentals, many traders will focus mainly on the balance sheet statement, with an extra emphasis on liquidity and coverage ratios. If the company's fundamentals deteriorated to those levels, thus threatening the dividend and the safety, this strategy would signal the investor to sell the stock. For example, when an investor purchases a stock, they may decide that if the stock falls 10% from where they bought it, they will sell it. Similar to the down from cost strategy, the up from cost strategy will trigger a stock sale if the stock rises a certain percentage. Both the down from cost and up from cost methods are strategies that will protect the investor's principal by either limiting their loss, stop loss, or locking in a specific amount of profit, take profit. The key to this approach is selecting an appropriate percentage that triggers the sell by taking into account the stock's historical volatility and the amount that an investor is willing to lose. The target price sell method uses a specific stock value to trigger a sell. This is one of the most widely used ways by which investors sell a stock, as evidenced by the popularity of the stop-loss orders with both traders and investors. Common target prices used by investors are typically based on valuation model outputs such as the discounted cash flow model. Many traders will base target price sells on arbitrary round numbers or support and resistance levels, but these are less sound than other fundamental-based methods. These common methods can help investors decide when to sell a stock,